Welcome back. Now, South Africa's mining production has fallen by 3.3% year on year in January, dragged down by manganese ore, gold and diamond output, while iron ore was a positive contributor. On a month-on-month basis, the picture is slightly bleaker with a decline of 4.6%. Kevin Lings, who's chief economist at Stanlib, joins us with his analysis of this print. Kevin, always a pleasure and a good afternoon to you.
Hi, good afternoon. Thanks for the invite.
Fantastic, Kevin. It looks like another, downbeat print, but I'm keen to have you contextualize it for us, as we see this fall of 3.3% year on year.
So these are not good numbers at all. They're way below what was expected. I think the market was hoping for a small increase actually year on year. And as you said, it went down 3.3%. I think that expectation of an increase was based on, if you go back, remember the fourth quarter, not long ago, we got the GDP number for South Africa for the fourth quarter. We grew by 0.1%. But one of the benefits in that fourth quarter was a better mining output. And so there was a bit of focus on that number to say, well, maybe, just maybe, there's a revitalization of mining coming through. And I guess some people thought that would continue on into the first month of this year. Turns out that was wrong. I thought this was a shockingly bad number. If you break it down, there are a whole lot of negative numbers, and some of the negative numbers are severely negative. And so when you look at South Africa's mining production now, you would say, well, last year in total, it was a decline. The year before, in total, it was a decline. This year started off bad. It's difficult to envisage that we are going to be able to improve this. And so it is putting that entire sector under pressure. And the importance is that while the sector's mining's only 4.5% of South Africa's economy in terms of GDP, right? So it's not the biggest component, but it plays a much bigger role than that 4.5% would suggest, because it's huge in terms of export revenue, and it also feeds into other industries. It helps mining, it helps finance, it's got forward and backward linkages to many other sectors. And so it's very unfortunate that we are unable to get mining production looking more positive. And we could talk about why that is, but it's not as if we can just come up with one answer. There's a tendency here to blame Transnet and the ports. That's part of the problem, but it's not the entire problem.
I'm going to touch on some of those issues that are causing good. What we are seeing here, Kevin, which I think is very important, is the steady decline, as you mentioned, of an industry that is an important part, a huge employer within South Africa here. And I'm keen just to get your thoughts on that. So maybe putting aside absolutely issues of Transnet, why are we not quite seeing a buoyant mining industry here? Is it got to do with deindustrialization in South Africa?
Yeah, so if you think about being in the mining sector, you face a myriad of problems. Yes, part of it is the fact that the rail system is not good and keeps breaking down. Part of it is the inefficiency at the port system. Absolutely, that hurts you. But on top of that, you've got problems with electricity production, and that adds layers of costs, or just really stifles your ability to produce. So you've got electricity. You've got problems with water supply because it's not as consistent as you would want. And then you've got problems with simply the cost of mining, as particularly gold mining, platinum mining. As you go deeper in the mines, as you try and find other ore bodies, and maybe those ore bodies are not as rich as some of the previous ore bodies, the cost of production tends to go up quite a lot. And so it's a battle. It's a constant battle to fight all of these issues. Now, for gold mining, you would say that that's in structural decline. It's an industry that has been declining for now a couple of decades, and that will continue on. But you would want other areas to be flourishing, right? So our big exports is coal and iron ore. We need to do better on those. Obviously, Platinum Group is it's the biggest component of the mining industry. We need to get more consistent output there. Unfortunately, because we're not getting that, I think what's going to happen is you're going to see less investment in the mining sector. We've already seen that. And you're going to see less employment. And we've already got these ideas of retrenchments or scaling back on the labor market. And it's not a good environment. The caveat, the positive, is that at least in terms of the price, if you factor in the revenue you're receiving in rands, that price is holding up. So I want to give you one quick example. I know we don't have much time, but if you take gold production, right? Gold production in the latest month was down somewhere between 12 and 13% in volume. But if you look at the revenue for the gold industry, it was up around about 113% year on year. Massive increase in revenue with a decrease in volume. That's simply because the gold price went to a record high and the currency's been weak. So the thing that's helping us a little bit is that we are getting decent revenue for some of the mining products, and the currency's helping us. It's very clear, though, we could be doing so much better, right? If we were able to improve the volume, get consistent production, it would be much better. And the last thing is, if I look at a breakdown of mining by key category, and what strikes me is the volatility of production from one month to the next, the constant disruptions. And so if you're in that industry, you struggle to get that consistent output. And without that consistent output, it's difficult to argue for new investment, new employment. So it's a troubled industry, but a vital industry.
That's all we have time for today, Kevin. Always a pleasure hearing from you, and I think certainly planting a seed for a longer conversation that needs to be had here about the sustainability of the sector for us. Thank you so much for your time. That was Stanlib's chief economist, Kevin Lings.